Hello, very good morning to all and happy Friday. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be the second trading day of a brand new year for 2025. Happy Friday. Welcome to today's Daily Dose of Market Insights. Today will be the 3rd of January 2025. So before we jump straight into our daily insights of market dose for today, let's have a quick view on this disclaimer slide first. All right, leverage trading carries pardon me, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the details of the intraday technical outlook on the various broad-based cross asset classes, ranging from the major dollar pair, the major stock indices, and as well as the two key commodities market, that is gold XAU/USD and West Texas crude oil WTI crude. Let's have a recap what has taken shape yesterday in terms of economic data, news flow, and as well as the intraday performance of the various broad-based cross asset classes. So let us start with the data release first. So yesterday we do have a second tier key data release of the US labor market, and that's important. Why? Because that will also give us a hint of where will be the US Federal Reserve monetary policy guidance will be in 2025 or in Q1 2025. So yesterday we do see the release of a second tier US job market labor data, which is the initial jobless claim, and initial jobless claim continues to actually drop to a 8-month low. All right, so it actually came in better than expected. Market is expecting 222k increase, but it came in lower at 211k and also below the previous week of 219k. So this is actually a weekly data, right? Not a monthly data. So if you look at the initial jobless claim trend as of the latest one for the week ending 21st of for the week of 21st of December, right? Let's give it a couple of seconds to run on my screen over here. All right, so what I could see over here is actually dropped close to a 8-month low. All right, to 8-month low. So that's indicating that the US labor market is still in a rather robust shape or robust environment, given that there are lesser people claiming jobless claims. So this is what it means over here. So with that, that also represents the Fed is likely will be no hurry to actually ignite deeper interest rate cuts in 2025. So the Dow hasn't really changed much. So if you look at the upcoming FOMC meeting, which is on the 29th of January, high chance that the Fed will stand pat at 4.25% to 4.5%. So this is the current rate right now after a 25 basis point cut in the December meeting. So market is still expecting a high chance of 88 or 89% of no change to remain at 4.25% to 4.5%. So that hasn't really changed much in about a week ago and a day ago. All right, over here. So previously was 90.4 a day ago on 31st of December, and yesterday it inched down slightly lower to 89%, almost the same, I would say. And if you look at pardon me, due to the bad cough of my voice over here, on the aggregate basis over here, what market is looking at is that it's still almost unchanged of either one or two cuts in 2025. All right, so likely it's still penciling at between 1 to 2 cuts over here. That's almost in line with the latest FOMC officials dot plot release in the December FOMC meeting as well. So a rather high chance of 79%. Market is looking at for another 25 basis point to come in only in the May meeting, 7th of May meeting, because it's at 79%. The one in March, about 50-50, is about 57%. So that doesn't really consider as a high odds over here. All right, so after the May FOMC meeting, then thereafter, market participants are expecting to stand pat at 4% to 4.5 to 5% in June and July, and likely to ignite another cut throughout in the later part of the year, either in October or December, because that has a high chance of 66% and 78%, bringing the Fed funds rate down to 3.75% to 4% before 2025 ends. All right, so that is also representing net overall is a rather less aggressive dovishness as being implied by the CME Fed Watch 2, taking into the latest pricing of the 30 days Fed funds futures market. Okay, so what does it mean for the FX market? For sure, that represent a continuation of the strong dollar as we kickstart 2025 yesterday. So that actually also came in within our expectations. So for those who follow our daily dose of market insight yesterday, we flipped to a bearish bias on the intraday basis on the euro dollar and the sterling dollar. All right, those actually have already made our short-term support yesterday. So what does it hold for the euro dollar and the sterling dollar for today? Stay tuned as I covered later in the intraday technical outlook segment. So if you look at the performance, the 5-day rolling performance of the dollar as of now, as we are speaking, all of them continues to show bullishness on the dollar against the rest of the other major currency. So the dollar was actually the strongest against the euro and the sterling yesterday as they traded above the dollar index, but kind of lagged behind against the CAD and against the dollar yen. But even though the dollar yen didn't rally much, it managed to actually help on to our key short-term pivotal support yesterday and shape a higher low. More details will be covered as well during the intraday technical outlook segment. But I want to share with you all is overall the push up on the dollar strength as being implied by the technical analysis of the medium-term technical analysis as being shown on your screen over here, which is the daily chart of the US dollar index. It has been trading in a bullish dynamic since the bullish breakout of this major symmetrical triangle range configuration from the low of 13th of July 2023. Okay, so ever since it showed the bullish breakout during exposed US presidential election outcome where Trump won the US presidency, it pulled back over here, managed to survive at the lower boundary of this medium-term ascending channel that I drew from the low of 1st of October, and as well as the pullback line of this former symmetrical triangle range resistance now turns into a pullback support level. And yesterday, price action was positive, added 0.72%, and yesterday's closing level was the highest since November 2022 over here. All right, as you can see. So the next intermediate resistance will be the upper limit of the channel at 111 level. Okay, 111, okay, 1111 level. Okay, 1 level above it says 113.90 slash 114.80, which is the medium term swing high area of 28th of September 2022 and 19th of October 2022. So overall, the medium term bullish trend of the dollar index continues to remain intact over here as it continues to trade above the 20-day and the 50-day moving average. RSI, yes, overbought, but hasn't really shown a bearish divergence, all right, indicating there's no exhaustion in this current medium-term bullish trend on the US dollar index. Yes, on the intraday basis, there is some push up and down over here that I'll share with you all, but from a multi-week perspective or a medium-term perspective, the dollar trend still remains intact. Right, so that's for the FX market. Now, for the US stock market yesterday, we see a bit of weakness, all right, due to mega cap technology stock, mega cap stock Tesla that actually has a horrendous performance yesterday. So what happened to Tesla? There was actually a negative news that took shape on Tesla is that its 2024 annual sales figure, means the total revenue for its EV actually came in slightly below prior year we call it level, and it meets estimate as well. So if you look at the current trend, okay, previously 2023 it managed to sold 1.8 million, but in 2024 it sold 1.789 million, a slight dip over here. So because of this slight dip in annual sales figure of its EV for 2024, in aggregate created a negative feedback loop to its stock price. So yesterday Tesla was down negative 6%, and as well as Apple was down negative 2.6%. Apple, there's no news catalyst to it. It's more related to technical and positioning. So because of these two, we call it mega cap stocks underperformance within the S&P 500 and the Nasdaq 100, that causes a lackluster performance in these two heavily weighted mega cap centric in the stock benchmark indices. So the SPX is down negative 0.22%, the Nasdaq is down negative 0.17%. The Dow Jones continues to underperform, down negative 0.36%, while the Russell 2000 remains unchanged. But what's interesting over here is that in the middle part of the session at 2 a.m. Singapore time, it managed to shape a recovery on the S&P, the Nasdaq, and as well as the Dow Jones. All right, and importantly, the Dow Jones managed to shape the recovery right at our short-term pivotal support level, and the Nasdaq 100 managed to reintegrate above the 50-day moving average. So later I'll share with you all a better view of the chart where we cover the intraday technical outlook on these two major stock indices, the Nasdaq and the Dow Jones. So net overall, because of that Tesla negative news flow, it created a bit of weakness in the first 4 hours of the US stock trading session yesterday, impacting the heavily centric SPX and the Nasdaq 100. But some signs of positiveness emerged during the last 2 hours or the last 3 hours of trading yesterday. Right, and that's pretty much sum up the intraday performance on the FX market and the major US stock indices. And one more particular news flow I'll share with you all is more of a longer term perspective in geopolitical arena, which is the relationship between US and China as we await for Trump administration coming into on the 20th of January, where Trump officially is being made as a US president. And ahead of that, we start to see a more frosty relationship between these two major superpowers. So yesterday, China announced it plans to export curbs of battery parts and mineral technology towards US. So we know that Trump administration itself, he wants to make US as a biggest manufacturer in terms of key industry, which is particularly EV is one of them. Okay, because we know that Tesla, Elon Musk close relationship with Trump going forward, and as well as certain mineral technology is so required to build this kind of EV as well. So yesterday, China announced more export curbs heading to for these battery parts and mineral technology heading towards US. And let's see how it unfolds. So it seems to us that this ongoing China-US tech war is now being led to a potential resource war as well, as due to the fact that Trump's campaign promises of inflicting more tariffs towards China products heading towards US. So we start to see this kind of more like kind of a tick for that rhetoric measures coming into play between these two superpowers. And how does it play out? It will have significant implication on the FX market and as well as their respective stock market as well. All right, so something to take a note of from a medium term perspective. Okay. Okay, so that actually sum up today's first segment of the Daily Dose of Market Insights, which is the relevant news flow and its so-called intraday performance that I already shared with you guys. All right, so without further ado, now let us now jump straight into the intraday technical outlook for today and what are the key levels and the trend bias that the major across asset classes could unfold on a shorter term perspective. But before that, let me expand my screen so that you guys could have a better view of the charts as usual. All right, so let us start with the FX market first. All right, so for the FX market, let's have a quick look at the euro dollar. Still recall the euro dollar yesterday, we do have a bearish bias. So the bearish bias hit all the way to our predefined support level at 1.0250, and this predefined support level actually managed to help with a bullish hammer formation at 12 a.m. Singapore time yesterday, and this 1.0250 was rather significant Fibo extension level graphically, as well as the lower limit of this minor ascending channel that I drew from the low of from the high of 6th of December. So with that, this will be a first support level to watch for today, 1.0250. RSI, no bullish divergence yet, but hit a extreme oversold level. So there will be a chance of a minor mean reversion rebound taking shape for today on the intraday basis. Okay, like I stress, is an intraday technical outlook. Overall, the medium-term trend on the euro dollar still remains bearish. Why? As explained earlier, I will show the strength of the dollar index, and we know that the euro dollar is a highest significant weightage in the dollar index. All right. So with that, I will be using a slightly 1.090 level as my short-term pivotal support, a slightly level below the first support level, where price action managed to survive yesterday at 1.0250, which is also our bearish bias support level to watch for yesterday as well. So using 1.0190 short-term pivotal support on the euro dollar, we will flip to a intraday bullish bias for today. Potentially there could be some form of a minor mean reversion rebound, I stress again, within its medium-term downtrend phase that is still intact. Intraday resistance level to watch 1.0330. A breakout above it may see 1.0380. All right, so these are the two levels to watch. First level, 1.330. Above it, 1.0380. However, if price action managed to collapse below 1.019 level, then today's intraday bullish bias will be invalidated to see the continuation of the impulsive down move within its medium-term downtrend phase to expose the next near-term support level at 1.015, followed by 1.0085, which is very close to the parity level. So that's for the euro dollar. Now, turning our attention will be the sterling dollar. So sterling dollar also very similar, almost come close to our support level at 12320/123 figure level. So also shape a bullish dragonfly doji at the 12 a.m. mark yesterday. So using 1.2320/1.23 figure level as my short-term pivotal support zone, we will flip to a intraday bullish bias for a mean reversion rebound within its medium-term downtrend phase that is still intact, as we know that the hourly RSI has hit a grossly oversold level. First resistance level to watch for this potential mean reversion rebound for today will be 1.2460/1.2410. Only a push down with an hourly close below 1.2320/1.23 figure short-term pivotal support will invalidate today's intraday bullish bias and see the continuation of the impulsive downward sequence within its medium-term downtrend to expose the next near-term support level at 1.22 figure level. A breakdown below it exposes 1.2140, which is the 1.38 Fibo extension level, and as well as this medium-term descending channel that is still in place since the high of 27th of September. Okay, this year. All right, so net overall, we will flip to a intraday bullish bias on the sterling dollar and for the euro dollar due to its grossly oversold condition on its respective hourly RSI, looking out for a potential minor mean reversion rebound in play within their medium-term downtrend phase that is still intact. So that's for the sterling dollar outlook. Now let us turn our attention now, to the Asia Pacific currency, starting with the Aussie dollar first. So the Aussie dollar continues to trade sideways below our first resistance level at 0.230, okay, which is also the median line of this medium-term descending channel that I drew from the high of 1st of October. All right, so with that, the hourly RSI, okay, also continues to shape a lower high. We could see over here, okay, a lower higher. So with that, still using 62.65 level, a slight level above our first resistance at 62.30. So 62.65 will be still remains my short-term pivotal resistance. So still having a intraday bearish bias on the Aussie dollar. First near-term support level to watch for today will be 61.60. Only an hourly push-up and the close above 62.65 will invalidate today's intraday bearish bias to see a mean reversion rebound kickstarting again, exposing the next near-term resistance zone of 63.30/63.50 next. All right, which is also correspond to the medium-term descending channel upper limit. right over here. So that's for the Aussie dollar, still maintaining that intraday bearish bias using 62.65 as my short-term pivotal resistance level. Now, what's up next for the dollar yen? So dollar yen yesterday, it rebounded but managed to shape a series of higher low right exactly at our first support level at 156.76 level. So still no change, still using 156.76 as my first support, but pivotal support will be slightly lower at 155.85 just in case of any whipsaw. So as long as 155.85 short-term pivotal support holds, we'll still maintain our intraday bullish bias on the dollar yen. First resistance zones to watch on the intraday basis will be 158.35 slash 158.80 for today. All right, as you could see, the hourly RSI also continues to shape a series of higher low holding above the 50 level mark as well. Okay, so that's for the dollar yen, still maintaining the intraday bullish bias using 155.85 as the short-term pivotal support level. Now, turning our attention will be the major stock indices over here, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index continues to trade below the 20 and the 50-day moving average, despite the bounce that we see right now on the intraday basis at the 10 a.m. hourly mark in Singapore time. And what we could see over here is there's actually a price action rejection, okay, by shaping a looming hourly bearish shooting star candlestick, right very close to the 20-day moving average at 19,900 level mark. So still no change, still using yesterday's we call it Tuesday's rejection level, and as well as the post-Christmas rejection level at 20,150, which is my short-term pivotal resistance level, still maintaining that intraday bearish bias on the Hong Kong 33. For today, first near-term support level to watch in this bearish bias will be 19,337 level. Only a breakdown below 19,337 exposes the minor swing low area of 22nd of November and 26th of November, acting as a next near-term support level at 19,030. However, if price action suddenly starts to shape a push-up with an hourly close above 20,150, today's intraday bearish bias will invalidated to see a choppy push-up to retest 20,520, which is the minor swing high of 11th of December and 12th of December, as well as confluencing with the former minor ascending trend line from 26th of November, now turns into a pullback resistance also at 20,520. So that's for the Hong Kong 33, using 20,150 to as my key short-term pivotal resistance to maintain the intraday bearish bias. Switching over to the Japan 225 or the Nikkei 225. So the Nikkei 225 going to trade sideways and now trying to trade it below the 20-day moving average. So overall, the Japan 225, after the failure bullish breakout on post-Christmas 27th of December, it still continues to be trapped within this sideways complex range configuration that is still in place since 26th of September last year. All right, still inside this sideways range configuration. So with that, still using the 39,830, pardon me, the 39,830 short-term pivotal resistance that we have for yesterday, still maintaining that intraday bearish bias within this sideways range configuration. First near-term support level to watch will be 38,870 slash 38,730 for today, which correspond to the 50-day and the 200-day moving average acting as a support level as well, and as well as the minor ascending trend line that is still in place since the minor swing low of 28th of November. Only a push up and hourly close above 39,830 will invalidate today's intraday bearish bias on the Japan 225 to see a push up towards the next resistance zone at 40,155 slash 40,420, which is the upper limit of that sideways range configuration. Now, turning our attention will be the German 30 or the German DAX. So the German 30 and German DAX continues to churn higher by shaping a series of higher low yesterday above our predefined short-term pivotal support level or support zone at 19,690 slash 19,590, which is also the rising 50-day moving average as well. So no change, maintain. Okay, let's put it slightly tighter. Okay, over here. 690. Okay, so using 19,690 as my short-term pivotal support for today, still maintain that intraday bullish bias on the German 30 or the German DAX. First resistance zone equal to surpass will be 20,105 slash 20,190, still remain unchanged. We also correspond to the 20-day moving average, acting as an intermediate resistance as well. A breakout above 20,190 exposes 20,360 next. All right. However, if a price action starts to shape a breakdown with an hourly close below 19,690, which is also closing below the 50-day moving average, that will invalidate today's intraday bullish bias to shape a continuation of this potential corrective decline scenario, exposing the next near-term support level at 19,445. Below it sees 19,155, which is the minor swing low of 22nd of November. So that's for the German 30. So what's next for the major US stock indices? Let's take a look at the US Wall Street 30. So the US Wall Street 30 tumbled yesterday, but managed to find support right exactly at the 42,210 short-term pivotal support level that we highlighted yesterday. So still no change, using 42,210 as my short-term pivotal support. Maintain that intraday bullish bias given that the RSI has started to exit from the oversold region already. First near-term resistance level to watch will be yesterday's minor swing high area, okay, at 42,960. Above 42,960 exposes 43,160 slash 43,335 on the intraday basis, which is this congestion area here from 26th of December to 27th of December. However, if price action start to have an hourly close and a breakdown below 42,210, then potentially we will have a residual push down to expose the major support zone of 41,840 slash 41,590. Why this support zone is important? Because it's the lower limit of this major descending channel that is still in place since 30th of October 2023. Okay, so that's for the US Wall Street 30, still maintaining a potential recovery scenario or a bullish bias, using 42,210 as my short-term pivotal support for today. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 yesterday almost managed to hit our first resistance level, which is 21,350, before plunging down and reintegrate back above the 50-day moving average again, which you could see over here, and the RSI continues to display that bullish divergence as well. Lower low, higher low. So with this continuation of that bullish divergence of the hourly RSI, we will still maintain the intraday bullish bias on the Nasdaq 100, given that yesterday he's almost hit the first resistance before plunging downwards, and using a slightly lower short-term pivotal support for today, which was correspond to the low of 20th of December at 21,780. So 21,780 short-term pivotal support level for the Nasdaq 100, maintaining that intraday bullish bias for this continuation of an intraday bounce that could potentially unfold on the Nasdaq 100. First resistance equal to surpass remains unchanged at 21,350. Only above 21,360 exposes 21,560 next near-term resistance level to watch. We also correspond to the 20-day moving average, almost acting as a similar resistance level as well. Only an hourly close and a push down below 21,780 will invalidate today's intraday bullish bias for the bounce scenario to flip to a corrective decline mode on the Nasdaq 100 that could potentially unfold, stretching from a multi-day perspective to a multi-week perspective. In near term, the next support level to watch will be 20,560 slash 20,530, followed by 20,335 level, which is the minor swing low of 15th of November and 19th of November last year. Right, so that sum up the intraday technical outlook on the major stock indices. Now, turning our attention will be the commodities market, starting with gold XAU slash USD. So for gold XAU slash USD, squeeze up yesterday, broke above the short-term pivotal support level at 2,630, and now hovering around the 50-day level mark, and as well as the 61.8 Fibo retracement of that previous decline from 12th of December to 19th of December, which is the resistance at 2,674. And given that the hourly RSI has really hit a grossly oversold level on an hourly basis, grossly overbought level, pardon me, not oversold, the hourly RSI hit a grossly overbought level on an hourly basis over here, there is a risk that the potential upside potential may be limited for now, given that it's also coming very close to a Fibo retracement resistance as well. and also correspond to this former graphical congestion zone area here at 2674, which is a 61.8 golden ratio Fibo retracement. So with that, we will flip to a neutrality stance using 2674 as an upper neutrality level. Lower neutrality level will be the 20-day moving average acting as a support level at 2636. So flipping to a neutrality stance for today, since there's also Friday as well, neutral between 2674 and 2636 on Gold XAU/USD. Only hourly close will push down below 2636, may see it floating downwards towards the lower limit of this triangle range configuration at 2006 figure level. Okay, so I could see over here, since the low of 14th of November, it appears to be trading in this kind of triangle range configuration potentially. All right, upper limit of the range 2716, 2726 for Gold XAU/USD. Okay, so net overall, flipping to a neutrality stance for today between 2764 and 2636. All right, lastly will be the West Texas crude oil. So West Texas crude oil continues to actually shape a push up within our expectation and hit our surpass 73.15 and hit our next resistance level at 74 figure level. All right, so this 73.15 was rather important because previously it was capping previous boost since 24th of October, and yesterday it managed to shape a push up from here. And during this push up, yes, the RSI hit a grossly overbought level, managed to shape that pullback, but during this grossly overbought level, there is no clear bullish or bearish divergence. There's no bearish divergence. Price action continues to shape higher high in line with the movement of the price action on the West Texas crude oil. So net overall, it means that yes, there could be some signs of pullback taking shape, but the West Texas crude oil could continues to much higher within this daily chart over here, this major descending triangle range configuration over here. So it could actually test the upper limit of the symmetrical triangle, of the descending triangle range, not symmetrical. It could test the upper limit of this major descending triangle range configuration at 77.95 in the days ahead. So on the intraday basis, I'll be using a slightly lower level than 73.15, using yesterday's European session low. All right, this little push down and this V-shaped recovery at 72 figure level. So any pullback that managed to hold above 72 figure level, which is our short-term pivotal support level for today, a tightened one, we will still maintain that intraday bullish bias within its major descending triangle range configuration that is still intact. Above 74 figure level exposes 75.30/80. We also correspond to the downward sloping 20-day moving average as well. Only an hourly close below 72 figure level will invalidate today's intraday bullish bias to see it floating downwards towards 71.30. Below it sees a reintegration to retest the 20-day moving average acting as a support level, and as well as the minor swing low area of 27th of December coming in as the next near-term support level at 69.85. So net overall, we'll still maintain that intraday bullish bias on the West Texas crude oil towards the upper limit of its major descending triangle range configuration using a tightened key short-term pivotal support level at 72 figure level for today. All right, so that's also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the calendar. What are the key data to look out for today? So today will be Friday, will also be a rather quiet session. One that is particularly pertaining to the German economy, which could impact the euro dollar and the German DAX, will be the labor market data out from Germany at 4:55 p.m. Singapore time, unemployment chain and unemployment rate for the month of December. And thereafter, during the US session, one particular tier 1 data as well will be the ISM manufacturing PMI out at 11 p.m. for December. All right. Then thereafter will be a quiet session, and in early Monday we do have this tier 1 China data, which is the Caixin services PMI data pertaining to the services sector of the Chinese economy. But the Caixin services PMI data is slightly different from the previously one released about 2 days ago. 2 days ago is the official MBS non-manufacturing PMI data. The Caixin services PMI data consists of
SME corporation. So this gives us a better picture of the overall services activity in China. Something to look out for, whether they could continue to inch up higher in line with the previously released MBS non-manufacturing PMI data that rose to close to a 6-month high. Okay, something to take note of. On Monday, before the start of our daily dose at 9:45 p.m. 9:45, okay, pardon me, before the start of our daily dose on Monday, 6th of January at 9:45 a.m. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here. Wish you all a great, restful, and good weekend ahead, and we shall speak again on next Monday. Thank you.